stop. Close that other tab. Stop checking your portfolio balance for the 10th time today, because right now, while you're wondering if you should buy this dip or sell this bounce, someone else already knows exactly what you're about to do, and they're positioning to profit from it. Here's what nobody tells you. The market doesn't care if you're bullish or bearish. The market cares if you're predictable. And right now, Bitcoin is painting a picture that makes almost everyone predictable. Look at this modest green candle, small push higher, nothing crazy, just enough to make the bears nervous and the bulls hopeful, just enough to make you think about clicking that buy button, just enough to make you wonder if you should have bought yesterday. That feeling? That's not analysis. That's the trap being set. Because here's the Karwasach, the harsh reality. Most people in this market are being used as exit liquidity, and they don't even know it. You think you're trading Bitcoin, but really, you're trading against people who see your stop losses before you place them, who know where you'll panic, who understand that after 3 days of red candles, even a tiny green one makes you want to believe again. And that belief? That's expensive. So in this video, I'm not going to tell you if Bitcoin is going up or down. I'm going to show you something more valuable: how to stop being predictable, how to read what the market is actually doing instead of what you want it to do, and how to build a framework that works whether we pump or dump next. Because if you're watching this, you're probably feeling one of two things right now. Either you're nervous, you've seen these small relief bounces before, and you remember what happened next. You got excited too early and watched your position bleed. Or you're sitting on the sidelines feeling like an idiot, watching price move without you, wondering if you just missed the entry, wondering if everyone else knows something you don't. Both feelings make perfect sense, and both feelings are exactly what the market is designed to create. Because emotional traders don't follow plans, they follow candles. And when you follow candles, you end up buying tops and selling bottoms while wondering why trading feels so hard. So let me tell you what's really happening right now. This is not a market that rewards you for having an opinion. This is a market that rewards you for staying calm while everyone else becomes predictable. And the most predictable thing people do? They simplify. After volatility, after chop, after getting hit 3 times in a row, your brain just wants it to be simple again. You want the market to pick a direction and stick with it. You want the chart to stop lying to you. But here's what professionals know. The market doesn't lie. You just don't speak its language yet. Because while you're looking at a green candle and asking, is this bullish? Professionals are asking something completely different. Who is trapped here, and where will they be forced to act? That's the game. And once you see it, you can't unsee it. So let me break this down the way an institutional desk would. No hype, no predictions, just cold mechanics and 2 clean scenarios that let you operate with clarity instead of hope. Because the move you're seeing right now, this modest daily push, is not just a bit of green. It's the market asking a question. Is demand real, or is it just reactive? And that question is about to be answered in a way that traps one side completely. Let me show you how. When Bitcoin drops and then starts pushing upward, the crowd splits into 2 tribes instantly. One tribe sees the bounce and thinks, finally, the reversal is here. They buy because the pain is fading and they don't want to feel stupid for missing it. The other tribe sees the bounce and thinks, perfect, I can finally exit. They sell because they remember the dump and they don't trust the market to be kind twice. Both tribes are playing the same game. Both tribes are providing liquidity. And the market's job is simple: harvest that liquidity by forcing decisions. Because here's the part that stings. The market is not trying to go up or go down. The market is trying to extract the maximum amount from the maximum number of people. And the way it does that? By making you feel safe at exactly the wrong time. That's why small green days after stressful periods aren't boring. They're the market's favorite stage to set. Because comfort is where late entries happen. Comfort is where people add size. Comfort is where stops get placed in obvious clusters. And clustered stops? That's fuel. So right now, Bitcoin is doing something very specific. It's negotiating, not trending, not breaking down. Negotiating. And in negotiation zones, the most dangerous thing you can do is assume the next candle will be honest. Because in negotiation, candles aren't designed to reflect truth. They're designed to provoke behavior. This is what retail misses. They think price action is information. Professionals know price action is bait. So the question professionals ask is this: is Bitcoin reclaiming acceptance, or is it just grabbing attention? Acceptance means the market can hold progress. You see follow through. You see dips getting bought without panic. Attention means the market spikes, gets you emotional, then reverses. You see fake strength followed by sharp rejection. The difference is subtle in real time, but it's everything. Now, before we go further, I need to address what you're probably feeling. Because if we pretend emotions don't exist, we lose the whole game. If you've been holding Bitcoin through recent volatility, you're exhausted. Not because one move was huge, but because the emotional switching costs have been brutal. Fear to hope, hope to doubt, doubt to urgency, urgency to regret. That cycle drains you. And when you're drained, you do one thing. You simplify. You say, just tell me if it's going up or down. You say, just tell me what the whales are doing. You say, just tell me if this is the bottom. But markets punish simplification when structure is complex. So instead of giving you a prediction you'll forget in 2 days, I'm giving you a framework you can use every single time Bitcoin does this. A framework doesn't tell you what will happen. It tells you what you'll do when it happens, and that's the only thing you control. Now let's step into the institutional perspective, because this is where retail and professionals see the same chart and interpret it in completely opposite ways. Retail asks, is price higher than before? Institutions ask, who is trapped and where will they be forced to act? Retail asks, is this a bullish candle? Institutions ask, is this supported by real participation or is it thin and opportunistic? Retail asks, what's the target? Institutions ask, what's the risk if this is a liquidity sweep? See the difference? Institutions don't fall in love with candles. They respect the possibility of deception. And in Bitcoin, where volatility can explode in seconds, deception is not the exception. It's the design. This is where liquidity comes in. And if you remember one thing from this video, remember this. Price does not move to where it should. Price moves to where orders are. So what orders exist right now? There are two massive pools of liquidity that matter. One pool sits above recent local highs, where shorts place their protective stops and where breakout buyers place their triggers. The other pool sits below recent local lows, where late longs place their stop losses and where panicked holders are ready to capitulate. These pools act like magnets, and the market will try to touch one of them, not because it's bullish or bearish, but because touching it releases fuel. If the market runs up into stop clusters, shorts are forced to cover. That forced buying creates a sharp move that looks like strength. If the market runs down into stop clusters, longs are forced to sell. That forced selling creates a drop that feels like collapse. Both are fuel events. Both can change character instantly. So this small push you're seeing, it's not just green. It's potentially the start of a liquidity test. And here's what most people miss. The market will tell you a story while it tests liquidity. It will show you candles designed to create a feeling. That feeling is usually comfort or panic. Comfort makes you chase. Panic makes you dump. Both are liquidity. So instead of letting the market tell you a story, tell yourself a better one based on mechanics. Here's the better story. Bitcoin is evaluating whether demand is real or reactive right now. Reactive demand is when people buy because price is moving. They're not buying from a plan. They're buying because they don't want to miss it. Real demand is when buying appears even when the market tries to shake it out. Real demand holds through pullbacks. Real demand doesn't vanish the moment the candle turns red. That difference will decide if this becomes continuation or a trap. Now let's zoom out just enough to bring macro into this without pretending we know the future. Bitcoin is sensitive to liquidity conditions. When financial conditions tighten, risk assets behave differently. When they loosen, trend behavior becomes easier. In mixed environments, Bitcoin becomes a pressure valve. It doesn't just move, it whips. And that whip behavior reflects uncertainty. It reflects participants with different time horizons, different motivations, and different levels of forced risk colliding in real time. Some are long-term holders who barely care about daily candles. Some are short-term traders who must act quickly or get punished. Some are leveraged participants forced to close when volatility expands. When these groups collide, you get market structure that feels violently alive. And that's what we're seeing now. A market trying to lift, but in a zone where both sides still have ammunition. Now let's talk about whales, because people obsess over this. Whales are not mystical. They're simply participants who can move size without caring about your feelings. They have two advantages: patience and information asymmetry. They can wait while you demand instant confirmation, and they can see where liquidity is thin and infer where the crowd is positioned. Their favorite strategy in moments like this? Inducement. They don't predict. They induce the crowd into taking the wrong side at the wrong time. If the crowd is too bearish, whales spark a squeeze, shorts cover, price rips. If the crowd is too bullish, whales yank the floor, stops trigger, price dumps. Notice what matters, not direction, imbalance. So what's the imbalance right now? In an environment where price showed stress then relief, the imbalance is psychological. People want simplicity again. They want a clean trend up or a clean crash so they can buy lower. But markets rarely give you the clean version when you crave it. They give you the version that makes you emotional, and this brings us to leverage, the invisible force that affects you even if you never use it. When the market pushes up slightly, leveraged longs appear chasing momentum. They enter with tight stops. That creates fragility. Then a normal pullback, nothing dramatic, hits those stops. Stops trigger selling. Selling creates downside. Downside triggers more exits. Suddenly, a normal retrace becomes a fast flush. This is why ugly moves often start from innocent moments. The opposite is also true. When weakness appears, leveraged shorts pile in confidently. Then a small bounce hits their stops. Stops trigger buying. Buying pushes higher. Higher forces more shorts to close. Suddenly, a modest bounce becomes a violent squeeze. Both are leverage-driven accelerations. And in negotiation zones, the market uses both. It squeezes one side, then punishes the other. That's why guessing direction here is dangerous. You can be right and still get destroyed on timing. Professionals don't ask, will it go up? They ask, how will it try to trick me before it goes up? Now, before we hit the scenarios, I want to highlight the psychological inflection happening right now. The crowd is at a decision threshold. If the market keeps pushing up, they'll believe danger is gone. They'll get careless, they'll chase. If it dips suddenly, they'll believe the worst is back. They'll panic, they'll dump. In both cases, the crowd becomes predictable, and the market loves predictable, your job. Become the one person who doesn't need the market to validate emotions, because the market can't manipulate what it can't read. That's the real edge. Now let's build 2 clean scenarios you can actually use. Scenario 1, bullish resolution. In this scenario, the push we're seeing isn't just relief, it's the early stage of structural shift. But structural shifts don't announce themselves with one candle. They reveal through behavior. You'd expect the market to hold progress better. Not perfectly, but better. Instead of sharp rejections, you see softer pullbacks. Instead of instant sell-offs on bounces, sellers fail to regain control. Instead of volatility expanding both ways, you see compression then expansion in one direction with follow-through. The key word is acceptance. Acceptance means the market is comfortable at higher value without getting slapped down immediately. Institutions look for this. They don't need the first move. They want the second move to hold. In bullish resolution, the market frustrates impatient traders by moving slowly. It builds. It stabilizes. It forces the crowd to stop gambling and start planning. And when the crowd stops gambling, markets become healthier. In this scenario, dips feel like opportunities instead of threats, not because you're optimistic, but because the market's response becomes consistent. Bids appear. Sellers lose power. Now here's the signal that matters most, the market's reaction to discomfort. If Bitcoin faces a pullback and stays calm, doesn't cascade, doesn't accelerate down, then demand isn't reactive. It's present. That's the heart of bullish resolution. Scenario 2, bearish continuation. In this scenario, the daily push isn't recovery, it's setup. The market uses this small rise to create comfort, reduce fear, and invite late buying. Then when the crowd becomes slightly confident, it hits them with downside. Bearish continuation isn't just about dropping, it's about failing to hold gains. Every time the market tries to lift, it meets supply. Not dramatic dumps. Just consistent selling that caps progress. Recoveries feel weak. You see quick wicks, failed momentum attempts, struggle to stay strong. And when it dips, it doesn't bounce cleanly. It bounces like someone exhausted trying to stand. That's the dead bounce signature. The key word here is rejection. Rejection means attempts at higher value get pushed back aggressively. And that's where bulls get trapped. Because bulls don't get trapped when markets are red. Bulls get trapped when markets look safe. In this scenario, the mission is forcing capitulation. Forcing the crowd to give up positions. Forcing emotional selling. Forcing liquidation behavior even from spot holders because fear becomes unbearable. I'm not telling you this to scare you. I'm telling you, so if you recognize bearish continuation early through behavior, you don't donate to it. You step aside, you reduce risk, you wait for clarity. That's power most people never use because they think not trading is losing. Not trading is sometimes the most profitable trade. Now let's talk real-time signals to watch. Without exact levels, without fake precision. Signal 1, recovery quality. When the market pushes up, does it hold or get sold immediately? Look for patterns. Look for whether progress is respected. If it can't hold anything, that's warning. If it holds progress and builds, that's constructive. Signal 2, pullback behavior. Does it feel like normal retrace or panic? Panic has speed, cascade, follow through. Healthy pullbacks feel controlled, not pleasant, but not violent. If every pullback feels like a trapdoor, structure is fragile. Signal 3, volatility character. Markets can be bullish and volatile, but character matters. Jagged whippy moves breed traps. Smooth controlled moves allow trends. If your chart tries shaking you out every hour, that's not stable. Signal 4, sentiment temperature. If small green moves make the crowd euphoric, that's dangerous, not bullish. Euphoria brings leverage. Leverage brings fragility. If the crowd stays cautious as markets lift, the move has room because fewer late buyers exist to punish. Signal 5, response to negative pressure. When something bearish happens, macro headline, red candle, selling wave, does the market absorb it or accelerate? Absorption is strength. Acceleration is weakness. Now here's what most miss. Time horizon warfare. Bitcoin isn't one market, it's a battlefield of time horizons. Short-term traders live in minutes, swing traders in days, long-term holders in months, institutions in cycles. When you don't know which game you're playing, you get emotionally dragged into wrong decisions. You'll start trading your investment. You'll start investing your trade. That confusion creates the exact behavior markets exploit. So define your role. If you're a trader, your mission isn't prediction. It's controlling risk and waiting for behavior confirming your scenario. If you're an investor, your mission isn't avoiding volatility. It's surviving it without doing something irreversible at the worst moment. Now let's ground this in cycle perspective. Calmly, no hype. Bitcoin's long-term story isn't defined by one push, dump, or week of volatility. Long cycles build through phases: enthusiasm, excess, correction, disbelief, rebuilding, expansion. The hardest phase psychologically is rebuilding because it doesn't feel heroic. It feels boring and painful simultaneously. It's where crowds give up. And if you're watching Bitcoin now feeling confused by small moves, that's not personal failure. That's the market creating emotional noise so only disciplined participants stay rational. Here's why the market loves small green days after stress. They create the illusion of safety without delivering confirmation. They make you loosen discipline, make you believe the trap is over. And when discipline drops, liquidity rises. The most dangerous moment isn't when everyone's terrified. It's when fear begins fading, but structure hasn't proven itself yet. So here's the practical conclusion that helps you operate right now. If Bitcoin continues lifting, don't worship the move. Watch for acceptance. Watch for progress being respected. If it pulls back, don't panic instantly. Watch whether selling gets absorbed or cascades. If markets become whippy and emotional, recognize the environment. Negotiation zones are where you trade smaller or wait. And if you're holding long-term, remember this: you don't need to win every day to win the cycle. You need to avoid the few emotional mistakes that permanently damage your position. I'll end with something professionals live by. The market isn't asking you to be brave, it's asking you to be consistent. Because consistency is what stops you from becoming liquidity. This content is for educational purposes only. Crypto markets are high risk and volatile. Make decisions based on your own research, risk tolerance, and financial situation. This is not financial advice.